Feeling the squeeze of rising prices? Despite the Fed's promises, inflation is climbing again, and unexpected rate cuts are on the horizon. Discover what this means for your finances and the economy in our essential update. The Federal Reserve has been stating that inflation is going down the drain, with street inflation declining. They have stated that 3 reduced interest rates will be implemented from the current period until the end of the year. However, this was not anticipated at the May meeting, which was expected to be no reduction. The Fed has held 5 meetings in June, July, September, November, and December, with 3 rate cuts. The pivot, when the Fed switches from rate increases to rate cuts, has been discussed for 2 years. The Fed started boosting interest rates in March, but they recently began trekking in March and completed it in July. This led to several rate rises and a peak in inflation in June. Wall Street began discussing the pivot in the fall of 2009, but they were mistaken for many years. Inflation peaked in June at 4%, the highest since the early 2000s. A year later, it had fallen to 2%. The Fed was aiming to get to 2%, but it wasn't achieved. They had the last mile to get a tiny amount down, but it has been going up ever since. Inflation is not just stuck, but has been going up since June. If you are worried about inflation, it's important to look at the data. The Federal Reserve's actions have been criticized for not being close to cutting rates, and the narrative that the Fed is not coming down is misleading. Inflation has ceased to decrease and is now starting to rise. To decrease interest rates, the Federal Reserve, Fed, has been working on a solution, but they have not yet found the proof. Oil prices are a significant influence on inflation, as they filter across the entire supply chain. Gas at the pump is an apparent indicator, but it also affects everything you buy, including transportation. When oil prices rise, trucks have to pay more for their diesel, which in turn increases the cost of goods like bread, fresh vegetables, and groceries. The price of oil and refined goods, such as jet fuel and diesel, also goes up, leading to increased prices. This is not only one driver of inflation, but also another. In the short run, 2 of the top oil suppliers in the world are Russia and Saudi Arabia, while OPEC is reducing output. This disinflation is occurring globally, but not in the United States. Other reasons include geopolitical uncertainty, transportation expenses, time delays, and other factors. Economists often argue that people cannot afford to acquire gasoline, but they do not have enough money to do so. They created the Consumer Price Index, CPI, which takes away energy and food from CPI. This is because people spend most of their money on these items. The Fed also uses another inflation index called PCE, which measures personal consumption expenditure. In conclusion, the rise in inflation is a result of various factors, including transportation costs, geopolitical uncertainty, and inflation. While it is important to consider these factors when analyzing inflation, it is crucial to recognize that the current situation is not sustainable. The text discusses the impact of inflation on the economy, politics, and everyday behavior. It highlights that people pay CPI, which affects their attitude towards the economy, political outlook, and consumption. The supply side is affected by factors such as reduced oil shipments, bottlenecks in the supply chain, and concerns about economic sanctions from the Ukraine war and Iran. However, if inflation persists long enough, it can spread to the demand side, which is psychological. The text suggests that we are currently in an extremely hazardous location, meaning inflation is coming from the supply side. At a certain point, inflation may tilt over to the demand side, with union contracts getting fairly decent. Some states are boosting minimum salaries, which may be unproductive, but may lead to higher prices in the near run. The text also discusses the assumption that there may be no rate cuts through the end of the year. However, the text argues that Wall Street is often out of touch with the situation and believes that rates will rise in September. The September Fed meeting is weeks before the election, so the Fed is not likely to lower rates in September for political reasons. The text concludes by stating that if unemployment is sluggish, inflation may increase, unemployment goes up, and inflation falls down. The Fed and Wall Street have been wrong for years, but the combination of inflation and unemployment has occurred. The text concludes by stating that the Fed's decision to cut rates in September is based on political reasons and not on inflation. The text discusses the concept of stagflation, which occurs when high unemployment and rising inflation simultaneously. It highlights that Wall Street often gets it wrong, as their models are flawed and the inflation is genuine. The U.S. economy has been in a depression for years, with a decline in growth relative to potential. This is because recessions are defined by 2 consecutive quarters of drop in GDP, while depressions are defined by months of decreasing GDP. The text also discusses the role of government spending deficits in fiscal policy, which is a form of monetary policy. The Federal Reserve, Fed, does this through monetary policy, while the Congress does this through fiscal policy. The text also discusses the concept of QE, which is the printing of money by the Fed. The text also discusses the concept of money, which is defined by the Fed as a series of monetary instruments. Some people believe that Bitcoin is money, but this is not the case. The text suggests that the U.S. has been in a depression since December 2008, with the stock market decreasing and the NIX index recovering. The text also discusses the concept of QE, which is the printing of money by the Fed. The author argues that the U.S. has been in a depression for years, with the middle class being wiped out and the affluent growing wealthy. The Federal Reserve, Fed, is responsible for creating money through quantitative easing, QE, which involves acquiring bonds from Wall Street and phoning key dealers to offer them year-end S, or offer me year-end S. The dealer delivers the bonds to the Fed, who pays and buys them with money that emerges out of thin air. This money is then paid back to the Fed as a deposit called surplus reserves, which the Fed gives them interest on. The QE money trillion never went anywhere, and the money never went anywhere. The money printing did not encourage development, as it never went anywhere. The economy is expanding, as shown in GDP, due to fiscal policy deficit spending. This is different from monetary policy because it works in the near run and can be inflationary. When the government spends money, they give it to the banks, who then give it back and destroy the money that Congress spends on deficit expenditures. The U.S. economy is growing at around %, which is modest compared to potential but decent growth. However, the debt is rising quicker than the growth, as measured by the debt-to-GDP measurement. This number is over 1% right now, the highest in U.S. history dating back to the late 20th century. In conclusion, the QE money printing has not had any significant impact on the economy, as it has not encouraged development or expanded the balance sheet. Instead, the U.S. economy is experiencing growth, but the debt is rising faster than the growth. The U.S. debt-to-GDP ratio is currently the highest in history, with a rate of about %. This is the highest since World War II, but even during that time, the U.S. won the battle and built up a lot of debt. The U.S. was a global hedge bot with a proportion of global production and capacity. However, the U.S. has a higher debt-to-GDP ratio, but it has not won any wars. The U.S.'s current debt-to-GDP ratio is at an all-time high, with the economy growing faster than the debt. This suggests that the U.S. is not receiving something for money, but squandering it. The problem lies in lower amounts of debt, such as the debt-to-GDP ratio around % when Ronald Reagan was sworn in. The reason for this increase is that the economy has grown faster than the debt. When the economy grows faster than the debt, the ratio decreases and the economy is robust. However, when the debt-to-GDP ratio is closer to %, the Kingian multiplier shrinks and the economy continues to grow. Political leaders often overlook the debt amount, which is going quicker than the growth. This results in defaults happening every year, as seen in Argentina. This highlights the importance of understanding the relationship between debt and GDP in order to manage economic crises and ensure a sustainable future. Argentina and other nations struggle with printing money due to the issue of borrowing in USD. If a country owes dollars, it cannot print the money to pay back the loan because they do not have a dollar printing press. In contrast, countries like the U.S. can print the money to pay off their debt, which does not lead to default or hyperinflation. The U.S. is the best model for understanding the U.S., as it borrows in a currency and prints its debt in Japanese yen. The U.S. debt is in cash, and the U.S. prints dollars. If debts are paid in the money printed, the U.S. will not default, but will enter into hyperinflation. Japan is an example of a country that has been in a depression since the sluggish development phase. The problem is that Japan obtained growth by borrowing more than it grew. The U.S. is the finest model because it borrows in a currency and prints its debt in yen. If debts are paid in the money printed, the U.S. will not default, but will enter hyperinflation. The degree distribution of government statistics is a key factor in understanding the situation. The average is a bunch of numbers summed up and divided by the number of numbers, which is what makes up the average. For example, when people claim real earnings increased by a percentage of nominal salary minus inflation, the average may be up, but the degree distribution can reveal the top 1% making, the lowest 1% doing, and the middle 1% doing. The average distribution of wealth is not ideal, with the majority going to the wealthy and influential individuals. This has led to unhappiness among the middle class, who are left behind by the financial crisis. Diversification is a key strategy to achieve larger returns with less risk. However, many people don't understand what diversification is, as they hold stocks in different sectors, but only one asset type, such as equities or stocks. Instead of investing in stocks, one should have some cash, real estate, gold or silver precious metals, and alternatives. These asset classifications do not connect to a high degree of financial stress. To achieve true diversification, one should scale down their equity exposure and choose what is likely to perform within the stocks. Defense stocks are expected to perform well due to the U.S. being behind in several wars and spending more money on defense. The issue of natural resources, oil, and natural gas is also a concern. Insiders like Nancy Pelosi and Paul may be buying stocks to gain wealth on government pay, but this is not a viable solution for everyone. Instead, they should focus on diversifying their investments and choosing the most profitable options for their financial situation.
Thanks for watching our video. If you enjoyed it, don't forget to give it a thumbs up and subscribe to our channel for more content like this. Also, hit the notification bell so you never miss an update. Your support means the world to us. See you in the next video.